Hello, I'm Dr. Rao. Welcome to my accounting lecture series. In this video, I'm going to talk about a special topic relating to inventory, load of cost or net realizable value. To start with, as with all assets, we use the acquisition cost method to record inventory when it is purchased. We choose a cost flow assumption, let's say it's FIFO, LIFO, average cost, specific identification, one of them to record the inventory when we sell it. The cost flow assumption we make does not have to match the physical flow of inventory. In most cases, companies do in fact choose a method that matches the physical flow of inventory. Now keep in mind, IFRS does not allow the use of LIFO. US GAAP does. So any problems relating with LIFO, we need to deal with it, but companies that use IFRS don't have to worry about it. Inventory is a very important asset as it represents future revenue of the firm. Financial analysis is based on this number, which could be unreliable if there is a potential decline in the value of inventory. This now leads us to our first special topic with inventory, and that's a lower of cost or net realizable value. I will work on an exercise to explain this. So let me start out with a screen share over here. So this is an intermediate accounting topic, and let's see what we are dealing with over here. I will work through an exercise with you, but let's first talk about the topic on hand. So what we have over here is a company needs to abandon that historical cost principle. Historical cost principle is we recorded our inventory at the purchase price. That needs to be abandoned when the future utility of the asset drops below its original cost. Future utility being revenue generation. I need to sell the inventory. So let's take a look at a couple of things that I've mentioned over here. Historical cost is based on the LIFO, FIFO, average cost, whatever the case may be. Based on that, we have the historical cost of our ending inventory. Now, why are we so hung up about the historical cost? Because it's representational faithfulness. We know what that number is. It is what it is. It's a purchase price. I know exactly what I paid for the inventory. Now, as opposed to that, I want to look at the net realizable value, which is the estimated selling price of the inventory. That's what I could sell it at in the future, minus any cost to complete and selling cost. So those are necessary costs that I have to incur in order to make the sale. So when I deduct those two amounts from the estimated selling price, it tells me what I can realize, the net realizable value of this asset. Why is this important? This is relevant. So we have the conflict of these two accounting principles. Do I want a number that's relevant, or do I want a number that I know is absolutely a correct number? That's a representational faithfulness principle we're talking about. So when do we look at this, abandoning this principle? When the net realizable value, that is what I can sell that asset for, is less than the cost, what I paid for, then we need to have a departure from the cost principle, which means we're going to abandon the cost principle in favor of the net realizable value at December 31st. So let's take a look at the exercise we have over here, and I'll show you how I work through with it. So we have a company that uses the LCNRV method on an individual item basis in pricing its inventory items. The inventory at December 31st, 2020 constitutes products. They've given us a variety of products, and they've given us the relevant information. So they've told us what the items are, what the selling price is, what the cost is, cost to complete, and selling cost. So I have all the necessary information to decide whether I should be using historical cost or the net realizable value for each individual item, because that's how the company does it. So they're asking us to use the LCNRV rule and to determine the proper unit value for balance sheet reporting purposes at December 31st, 2020 for each of these inventory items. Now, we're also going to do a journal entry, which is not asked in the exercise, but that's just to complete this topic. So let's see how I've structured my file over here. So I'll tell you what my headers are over here. I have exactly the same as we have over here, the item numbers. And then what you will see is I've rearranged the terms slightly over here. I have the estimated selling price, that's the first one. To arrive at the net realizable value, I need estimated selling price, less cost to complete, less selling cost. So I'm just going to rearrange the information given. So estimated selling price, then I'm going to skip over, go to cost to complete, and then selling cost. So when I deduct these two costs, I will get the net realizable value. So I need to do that calculation. And then I have the historical cost, that's a cost that's given to me over here. And then finally, I will choose between the two, the lower of the two. So let me start out just for one item first. For item B, the selling price is 120. The cost to complete is $30. The selling cost is $10. Remember, these are all estimated. Cost to complete, selling cost, it's out in the future. So 120 minus 30 minus 10 gives me $80. Now, just a quick note over here. I'm doing all of my work in Excel, so it makes life a lot easier. So I've set up a formula over here where I'm saying 120 minus 30 minus 10 is 80. I have my historical cost, that's 75. I've typed that number in. Now I need to choose between these two numbers. Which is the smaller of the two numbers? 75. So I stay with 75. Again, using Excel, what I've done is I used a formula and I said, give me the minimum in this range. So the range is these two cells, and I said, give me the minimum, the smaller of the two numbers, and it picks 75 for me automatically. Now, as you can tell, this is a very easy exercise. Once I set this up as a formula, I just need to enter basic data, and I can have all my answers. So I'm just going to reveal my answers over here. Follows the same pattern. And what I am now concerned with is historical cost. My inventory, if you look at the total, in my balance sheet at December 31st, I have it at 401. Again, using Excel, I just said, give me the total of all of these cells. It was 401. Now that I'm choosing the lower of the net realizable value or historical cost on an item by item basis. So over here, let's just quickly go through this, and let me highlight it in a different color so you can see this. I chose this number. The lower number is where and you will see this number was the lower number. Here, this was a lower number. And again, here, this was a lower number. Okay. So exactly 3 items. The cost is still lower than the selling price future potential. So we stick with the cost. For 3 other items, the future selling price is lower than the cost. So we stick with those. So we have the total cost at 401. I take the difference between those numbers. Now, total net lower of cost or net realizable value, I said should be 318. So the difference between the two is $83. So the inventory that I have at 401, the total inventory, I need to drop it to 318 by choosing the lower of the two numbers. Here are the 3 numbers that I chose that are smaller. Okay, it's because of these 3 numbers. These 3 numbers, the difference that I have over here, okay, that adds up to $83. Those are the numbers that I need to choose. So once again, let me just show you how I came up with those numbers. It's going to be 862 minus 80. Need to change the color here. And then I have 60 minus 80. And here I have 35 minus 80. Okay. Once again, if you add these 3 numbers, you will come with that come up with the $83 difference. Okay. The goal over here now is I need to lower my inventory, the value by $83. In the balance sheet right now, it's 401. I cannot magically move to 318 without doing a journal entry. Remember, in accounting, everything that has to come into your financial statements comes by way of a journal entry. The book of original entries, remember, that's a journal entry. So we have 2 ways in which we can do this, the adjusting entry. One is called the direct write-off method, And the second method is called the allowance method. A company has to choose one of these two. Okay, they're not going to do both the journal entries, they're going to do one of these two, and we'll see how it is done. Scoot up over here. Okay, so this is at December 31st, 2020. My journal entry would be cost of goods sold debit, inventory credit, and that's for the $83 difference. Okay, so I'm lowering the value of my inventory. Inventory is an asset with a normal balance of debit. I'm decreasing it by crediting it, and I'm charging it to cost of goods sold. Or another way in which I could do the same journal entry, the amounts are not going to be different. This is again still the direct write-off method. I could, inventory is credited in both cases. I could debit loss due to decline of inventory to net realizable value. And I write this as a separate line item. What's the difference between these two approaches? In this approach, it goes to cost of goods sold. It's going to lower the gross profit in the current period. This one still goes into the income statement, but it doesn't affect your gross profit number. So numbers are very important. Recall what I started out by saying, gross profit is a number that is used in a lot of analysis. This inventory number has a significant impact on a lot of ratios. Now, if companies go through this frequently, what they may do is they may use an allowance method instead. In the allowance method, our journal entry, it's for the same $83, will be set up as loss due to decline of inventory to net realizable value like we did over here. But the account we credit is allowance to reduce inventory to net realizable value. That is similar to what you would do with your bad debt accounts if you have the allowance for doubtful accounts. So companies have one of two ways. Either way, I want to reduce my inventory by $83 to reflect the lower of cost on net realizable value. I'm doing this on an individual item basis. It could be done for inventory as a whole. It could be done in many different ways if I group my inventory, if there's some logical way in which I want to group my inventory. Again, in this particular exercise, I looked at individual items because this is what the exercise asked me to do. Once again, this is the first topic, special topic relating to inventory. Please watch my other videos to see the other topics relating to inventory. So with this, I'm going to stop this meeting, and I shall start my second lecture in a few minutes.